Hi everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into a Form 8K from GT Biopharma, and let me tell you, it's a bit like finding out your doctor accepted payment in cookies. Seems odd, right? Well, let's figure out what's going on. This report tells us about a deal involving stock warrants and services. Basically, the company got some work done and paid for it, with the potential to own company shares but not in cash. Let's break it down. The main thing here is that on March 31, GT Biopharma made a deal with Cytovance Biologics. Cytovance provided some services to GT Biopharma, and instead of paying them cash, GT Biopharma gave them what's called a pre-funded warrant. A warrant is like a coupon that allows Cytovance to buy shares of GT Biopharma stock in the future. In this case, it's a pre-funded warrant, which means Cytovance already paid for it by providing the services. The warrant allows Cytovance to buy up to 326,251 shares of GT Biopharma's common stock. That's a significant chunk of shares. This is stock that can be acquired, it's not stock they immediately got. Now, here's the interesting part. The price to buy each share with the warrant is super cheap, only $0.1 which is practically nothing. The catch is that Cytovance already paid for this warrant by providing services that were worth a lot more, specifically $840 more specifically 846,500 actually get them. This whole deal was done without registering with the Securities and Exchange Commission or the SEC. GT Biopharma is saying they didn't need to register because it was a private transaction, not a public offering. This means they believe they followed the rules for selling securities without having to go through all the usual paperwork and scrutiny. If you want to know every single detail, you can check out the warrant itself, which is included as an exhibit to this report. It's basically the legal document that spells out all the terms and conditions of the deal. Now let's zoom out and think about what this all means. GT Biopharma needed services from Cytovance but chose to pay them with a warrant instead of cash. This can be good or bad. On the one hand, it saves GT Biopharma cash, which is always a plus, especially for smaller companies. On the other hand, it dilutes the value of existing shareholders' stock, since there will potentially be more shares floating around if Cytovance exercises the warrant. Also, the fact that Cytovance agreed to be paid in warrants suggests that they believe in GT Biopharma's future. They're betting that the company's stock will go up in value, making those warrant shares worth a lot more then. So, what's my take on all this? Overall, this looks like a way for GT Biopharma to manage its cash flow, which is common for smaller companies that are still growing. However, investors should keep an eye on how many warrants and stock options the company is issuing, because too much dilution can hurt the stock price. One potential risk is that Cytovance could sell those warrant shares quickly if they need cash or if they lose faith in GT Biopharma. This could put downward pressure on the stock price. On the other hand, if GT Biopharma's stock does well, Cytovance could make a nice profit and everyone's happy. In conclusion, this warrant deal is a mixed bag. It helps GT Biopharma conserve cash, but it also creates the potential for dilution and volatility. Investors should weigh these factors carefully when deciding whether to invest in the company. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings. And let me know in the comments what company you'd like me to decode next.